All right, moving ahead. Now, just one tongue twister question before we move ahead, because I think audience at the back, are we there? Balcony audience, are we there? Yes, no? I can't hear. Yes, no? Okay, because we have more power on sessions going on. So I just want to ask one question from the audience. Anybody can raise up or give an answer, however you guys are comfortable. What is more important? Anyone? Time or money? Sorry? Well, that's a well-deserved answer, but anything if you want to choose. Okay. So I don't want to say that, but Mr. Ambani has both things important. All right. So the answer obviously is correct. Time and money and time both goes hands in hand. However, time is more valuable, guys, because you can have more money, but you cannot have more time. Same goes with this session. So we do not have time. I want everyone to quickly put your hands up together for another powerful runner-up session over here. Thank you. For real estate and real asset investing over here, building and rebalancing your portfolio. May I please take the pleasure to call on the stage Amar Merani, Head, Real Estate and Chief Investment Officer, IIFL Asset Management. Everyone! Good evening, sir. And then we can have on the stage Balaji Rao, Managing Partner, Real Estate Access Management. Thank you. Then we have Mitesh Agrawal on the side, Founder and Managing Partner, NovumLake Partners, Moderator. Everyone! And then we have over here Yash Ravel, ED, Fund Management and Corporate Strategy, Welspun, One Logistics Parks. Everyone, come on! Especially to my balcony audience. All right, great. So my powerful audience, are we ready? A little louder, are we ready? Great. Thank you so much. Over to you, gentlemen.
So good afternoon, everybody. We have a stellar panel for real estate, tons of experience in the real estate investment industry. I would jump directly into the speakers and take their views. I'd like to start with Balaji. Balaji is truly a veteran of the real estate investment industry. Most people like me would say that the institutional investment in real estate in India started in 2005 onwards. But if you ask Balaji, he was already in the industry for 15 years before that. So he's somebody who's been there, done that. It would be great to get Balaji's views on the real estate industry, Balaji.
Oh, thanks. Good evening, everyone. The way I look at real estate in the alternative space is clearly it's a cornerstone of anyone's alternative portfolio. Most people invest in what I call paper assets. Even if you don't go into the digital asset space of cryptocurrencies and NFT, paper assets actually dominate your portfolios. But if you look historically over the centuries, wealth has been built by real assets. And we tend to forget that because paper assets look more good, it's more, maybe more sexy, if I can use that word. And everybody thinks that they should be traders or long positions, short positions. But I think real estate is basically the foundations of anyone's wealth creation. And so if you're asking about portfolio rebalancing or anything, I would tend to be biased, but I would feel at least 50% of your portfolio should be actually weighed by real assets if 50% of it is being done by paper assets. So that's my way of looking at it. As we go on, I will talk to you more maybe as to what has changed in the real estate industry over the 3 decades I have been in it. And it would be interesting to see that the way it has changed, it is today, I think we are on the cusp of a real estate resurgence. And this is where I would tend to estimate you will make the best returns, at least the best risk-adjusted returns, albeit most of us might have suffered in real estate investments earlier. I still believe the golden era is yet to come. And that's what I'm really counting on. Back to you.
Thanks, Balaji. I request Amar to give his views on the industry as well. Amar is somebody who has literally like a 360-degree view on the entire industry. Amar's worked on the investment banking side for a number of years, done some of the largest real estate IPOs in the country till date. He started an NBFC from scratch, scaled that up, and now leading probably the largest domestic franchise in real estate investing at IIFL. Amar, over to you to get your views on the real estate investment industry. Where do you see the opportunity in real estate?
Thanks, Mitesh. Happy to be here. Good evening, everybody. So just to add to what Balaji and Mitesh have mentioned, real estate 10 years back, 20 years back, 5 years back, depending on which conference at what time period one went into, that was the time at which the appropriate risks and rewards were highlighted. But I think now, having seen a few cycles, all of us have seen these cycles, all of us have seen the kind of risks play out in real estate. In terms of the overall governance and the cleaning up of the sector and RERA and GST and demonetization and so many things that have happened in the last 7-8 years. And now if you see the sector, both in terms of the developers as well as in terms of the finance providers and the maturity of the overall regulatory regime, it's very, very different from what it used to be when things first started out in the mid-2000s. On a formal basis after Press Note 2. That was a time when within investment banking, we would sell hundreds of millions of dollars worth of equity investments just based on business plans alone, without any extent of legal or any other due diligence associated with it. Very different time and age. But now, of course, things are very different. It's far more bottom-up, far more detail-oriented, far more involved, and therefore it requires a lot more of skills which now the teams possess on the ground. It's a lot of micro skills. It is absolutely, suppose you're investing in real estate in Bombay. Bombay also is not, whether you're investing in central suburbs or city, which DCR, what regulation has been approved, which approval, what FSI, all of those things now become far more important compared to what it used to be. So that is how the sector has changed quite a bit. And therefore, since the risks are more clearly understood, the returns also are in a more predictable and definite band compared to what earlier they would have possibly been for investors. So if earlier investors were looking at 20, 25, 30%, now that would definitely not be the case. It would be sub that. It would be in the mid to high teens at best, is something that what the investors can and should look at in this sector on a more matured basis, because anything more than that and you're asking for trouble, because then you get into distressed and into the rocky territory, which the returns seldom would come. It would just be paper that would be hanging at the end of the day. So I think that extent of knowledge and maturity has come in the investors, developers, and regulators. And now it is going to be more predictable, less number of players, therefore far more to be done by each player going forward, less number of people who would rock the boat unnecessarily, and therefore more returns, and definitely far higher risk-adjusted returns to be made going forward.
Thanks, Amar. Great to know in terms of times are definitely changing and for the better. I'll request Yash now to speak maybe on warehousing. Sure. Yash and Welspun have a number of firsts to their credit. I think Welspun is the first warehousing specific fund that has been raised in the country, probably the first fund which took development into its own fold and had in-house development team. And I think the first fund was not only successfully raised during COVID times, they've deployed it, and now on to the second fund. So how was the experience, Yash, on the warehousing fund side?
Sure. So Mitesh, so first of all, I concur with Balaji and Amar in terms of how the real estate private equity world has sort of evolved over the last 15 or so years. I think both of us are similar vintage in terms of when we entered the industry. So one is that obviously the industry itself has matured. I think all of the players have now learned their lessons where, starting from the developers to the intermediaries to the financiers, the entire system is now much more sophisticated in terms of being able to identify and underwrite risk, right? That said, just taking a step back, when you think about real estate, especially from an India perspective, I think culturally Indians love real estate, right? So notwithstanding, perhaps the unfavorable cycles which we have seen in real estate over the last maybe 8-10 years, where that journey has not been stellar for anyone who invested during that vintage. But the fact remains that real estate or real assets as a broader investing theme is or should be a very important component of your portfolio. And the good thing is that now the market has evolved enough where it is possible to sort of financialize these investments. So starting with REITs, where earlier, if you wanted to buy a good quality commercial asset, you'd actually have to go and physically buy an asset, find a tenant, deal with operational issues with the property, and a lot of the hassles which come with physical ownership of real estate. Now, the great thing is you can actually get exposure to the same underlying by simply going and buying units of a REIT, right? When you think about real estate alternatives, I think in many ways it kind of takes that a step further, where it kind of allows investors to do what they love, which is investing in real estate, without any of the hassles of really buying land or owning or developing or operating physical real estate, right? And that's kind of what we tried to do with our warehousing fund, right? Where, and again, maybe we'll talk more about the sector itself as we progress. But warehousing, as many of you would know, is a very exciting sector where we're seeing a lot of growth, we're seeing excellent returns. And on the other hand, when you look at the asset from a risk perspective, it actually looks very, very de-risked, right? So what we're trying to really do with our product is to financialize that entire journey of value creation, starting from the land buying stage, through the leasing, through the development, and then through the exit of the asset, right? And again, earlier, the way someone would get exposure to that is probably park money with a local developer or buy a subscale, warehousing or industrial real estate product, right? Now, what we are able to do is really offer that same product in a much more transparent, organized manner, which is a SEBI-regulated, AIF kind of a structure, where we are, effectively allowing the investor to participate in the same underlying, where he gets the benefit of the entire value addition, right from the land stage through the leasing and development and then exit of the asset.
So that's great because investors, in effect, get a benefit of not just the investment, but also the development experience and expertise that you have is all. That part of the value chain is also captured for the investors.
Yes.
That's great. Balaji, I'll request you if you want to touch upon sub-asset classes within real estate, be it office and residential. How do you see these panning out? Maybe opportunities there in both, but in terms of returns for these asset classes, risks in these asset classes, growth in these asset classes.
Good. Real estate actually can be sliced into various asset classes. Generally, it used to be residential, commercial, industrial. And one of the subsets of the commercial used to be retail, and then you had the hospitality coming up. But today, I think it has become far more complex than that. And you have the specialized real estate which has come up, which one of it is really big and growing well and has great potential is warehousing and logistics. The other one will be the data centers. Third will be the service real estate which will come up, which might go into student housing, co-living, as well as assisted living. So there will be various sub-asset classes in real estate which will have varying risk and return profiles. So basically, I think as we progress as a nation and as an economy, I think it will become more complex. And one of the ways to try and mitigate this complexity would be the use of funds and fund managers, because just like what you had seen in equities and debt, it's more useful to have a professional fund manager who understands the complexities, knows when, where, and how to invest, rather than do so individually. Because if you really look at real estate as Mitesh has already put me in the dinosaur category. So let me talk about pre-91, pre-liberalization. It was a mom and pop store. People would just do some advance booking of flats and then wait till it is ready and then try to cash out. Post 91, the banks have started giving money more formally into the real estate sector, and we saw the advent of larger and larger residential complexes. So from standalone, you had apartment complexes, then slowly the townships came into being, and you have this Hiranandani garden type of mixed-use developments really taking the center stage. But the real kicker, as Amar put it, is when the Press Note 2 came in 2005 and allowed FDI to come in. And FDI poured into real estate, but the mistake that was made is though we had foreign investments pouring in and some domestic investments also through those early PE and VC funds, they were not regulated. So there was really no hardcore regulation of any sort. And no industry, including your stock markets, have really flourished without regulation. So to take an analogy of stock markets, only when SEBI came into being in the early 90s, around 92, 93, after the Harshad Mehta scam, did your stock markets actually take off. Similarly, in real estate, that came about much later when regulation came about with the help of RERA, with the help of maybe GST, with the help of IBC. All these happened successively during 2015-16. And that is one of the reasons today, when I talk about real estate, I say that we are at the cusp of a golden era. Because today you have the regulation. So today, even when we get foreign investment, or you see domestic private investments through AIFs, we realize that they're regulated, they're governed, and we have some enforceability of contracts, even if not through the courts, through the IBC process. So this is helping the growth of real estate in various asset classes, whether it's specialized or serviced, or regular asset classes like industrial and commercial. So today, if you look at the frontiers of real estate investing, three main features have come up. One is what I just described, the formalization of real estate, thanks to this legislation and governance. So we are more corporatized, we are more professional. The second is the financialization of real estate that Yash has spoken about, which talks about how you can have various instruments that are derivatives, and you have the underlying security as real estate, whether they are AIFs, fractional ownerships, or you have the REITs, InvITs, all these have actually financialization of this real estate and real asset. And finally, we have the digitization or technology slowly emerging in real estate also, which helps us a lot, not just in the construction process through ERPs and SAPs, but also in the customer relationship management and also in the investing side of it. So all these are the three new features of real estate, and I think these are necessary because of the complexity which we are going to see in the next decade, when there will be a far more specialized asset classes in real estate than we have ever seen before.
Thanks, Balaji. Great, always great to understand the entire context and history and to how things have evolved. The other thing which I want to cover on the panel today is in terms of the return profile from real estate. So depending on who you ask what the past experience has been, you would get two very different sets of answers. If you were to ask some of the foreign investors like Blackstone, Brookfield, New Vernon, who largely did commercial real estate over the last 10 years, they've reaped a ton of money, a ton of return. The Blackstone global CEO, Schwartzman, has gone on record saying office real estate in India has been the best performing asset class across Blackstone portfolios in the world. But if you ask domestic investors in India, largely the experience has been suboptimal. Amar, the question is to you, would you like to discuss this dichotomy, and importantly going forward, how do you see the returns from this particular asset class from real estate?
So I think the returns is a function of where the money went and what was the investment strategy, and at what point of time was the entire fund or the fundraising a part of. So if you look at residential, let's say in the period of the flux when the industry really metamorphosed from a semi-organized to a highly organized sector, which is now what it is, which was, like Balaji mentioned, 2015, 16, 17, 18. That was a time frame when we saw successive changes year on year, demonetization, GST, RERA, then the NBFC crisis, and then COVID. So all of that took its toll on a bunch of real estate funds which were launched at that point in time in 2016, 17, which were largely focusing on the residential sector. However, if you look at funds which were largely focusing on the office sector, and there were quite a few of them in the early 2010s, some like a Blackstone or a Brookfield or New One on which you mentioned, those have made a good amount of money because not only were they early in the game at that point in time, they also were a beneficiary of the entire office boom that took place in the country, the entire offshoring, outsourcing wave that took place. And there was no equivalent of a RERA, GST demonetization in that sector. And that was largely the B2B sector. So it all depends on what the investment strategy was, which period of time are we talking about. But on the whole, I would say, given that this negative experience is now firmly behind us, at this point in time, whenever I meet real estate developers, and earlier there were tons of them in every city, now one can count not more than 5 or 6 in every city that one can do business with on a ongoing scaled up basis. So there is enough and more appetite for larger developers to raise capital. There is not enough fund providers, and that therefore lays the ground for much higher quality transactions and therefore far more firm, far more predictable returns for investors going forward in time from here onwards. So that is something which I would be very certain on saying that now onwards is a good time from a very low risk and a moderate to good return basis from a residential portfolio as well as from a commercial portfolio, because commercial has been benefited by the entire REIT regime that's happened. I mean, of course, last few days we are seeing this, some of the REITs coming off in prices, but even then, I was just looking at the prices this morning of the 3 listed REITs. Even then, even after 3 knocks, now let's look at the REIT segment for a moment. There is the entire work from home cloud that's still there in terms of how much occupancy in office will take place and is taking place. So occupancy shot up in 2022, but now they have remained at about 50-60% for the top SEZs and IT parks. Then there's this entire interest rates which are close to the peak at this point in time, and therefore there's a dampening on the REIT sentiment. And now there's this tax element which came about on the principal repayment component of it, the taxable element. In spite of all these 3 knocks that this REIT sector has taken, still all the 3 REITs are trading above their issue prices as of today. Of course, distributions are absolutely regular and absolutely as good as clockwork. So, which therefore lays the ground for a even better outcome in the times to come, because having seen the worst in terms of the work from home and COVID and interest rates and tax, now the expectation is that because our assets are doing well operationally, and we've seen all these knocks happen in this sector also, things should be going better for the office space also going forward as far as the REITs are concerned. So that's what I would say on this, but just on another aspect which I would also like to highlight, and that's also the theme of this conference, which is real assets. So we are, for example, focusing a lot also on other assets outside real estate, which are real assets. So for example, road, highways, renewable power, transmission lines, gas pipelines, and so on. So if you look at the InvIT space, the entire infrastructure investment space, that is actually doing extremely well. There are 3 listed REITs. There are 19 InvITs that are currently on SEBI website, for example, out of which 3 are publicly listed and about 10 to 12 are privately listed. Now each of them has, because these are all running operational toll roads or transmission lines or solar power plants and so on, the cash flows are so regular and so predictable and so certain that InvITs, the distributions in these InvITs is around 8, 9, 10, 11, 12% per annum. So that is something which also is quite exciting for investors and for many of our clients who view them more as a predictable yield play, and they are listed also. So therefore there is the same element that is there in REITs. And that is something which we have built around and launched a new fund also, which deals only with InvITs. and to become InvIT. So there is a lot of interest in the real asset segment, which is a straight beneficiary of inflation also, because in toll roads, for example, the tolls are linked to inflation straight away. So whenever you have high inflation, we actually benefit in tolls, in renewable power, in transmission also to some extent. And the government is also fairly and firmly behind infrastructure, where they have launched this national modernization pipeline of 6 lakh crores, and there's a push from the government right from the top to make good the entire deficit that's happened in the country over the last 70 years in infrastructure. So there's a lot of interest also in real assets from investors, and going so even more as we are figuring out ourselves.
Thanks, Amar. Yes, I'd like to again request you to touch upon warehousing specifically and take a deep dive into it. So on one hand, maybe the cap rates have come down, which means that means that future returns might be on the lower side. But at the same time, in terms of penetration, in terms of demand, in terms of the total size of the industry in India as compared to even some of the Asian peers or certainly the developed markets, the Indian market is quite small, and which means there will be huge structural growth going forward. In terms of rents in India are probably much lower than, again, as compared to the Asian peers and developed. So what do you think is the reality? So how do the returns sort of stack up over the next 5 years or so from the warehousing sector?
So, Mitesh, I always compare sort of the warehousing sector with what we've seen on the commercial office side, right? So think back to commercial office in 2005, right? And what you had then is that on the one hand, you had very little good quality office stock which was available in the country. On the other hand, all of a sudden you had all of these large IT companies, MNCs, financial services companies entering the country, and they all demanded high quality office space, right? And that's really what set off the boom in office, which we've now seen over the last 15 or so years. So if you think about warehousing, warehousing is kind of where office was in 2005, right? So today, when you look at pan-India warehousing stock, the number is really, really low. On a per capita basis, I think India is about 0.1 square feet per capita. China is about 50 times that much. The US is about 400 times that much, right? And again, to put that even more in context, if you look at India's total pan-India warehousing stock, it's about 280 million square feet, I think, give or take. That's approximately equal to the amount of warehousing stock in Boston City, right? So one large city or one large size city in the US has as much warehousing stock as what we have pan-India, right? So the headroom for growth is clearly very, very large. We're also seeing that now there are multiple engines which are driving growth, both from a consumption standpoint and from a manufacturing standpoint, right? So on the consumption standpoint, obviously e-commerce is one of the large drivers of growth which we have seen over the last 4 or 5 years. More so, I think, post-COVID, where e-commerce penetration suddenly spiked through the COVID period. Of course, now it's kind of come back down from that sudden spike growth to normal growth, but it's still good growth all the same, right? And then, it's not just the e-commerce growth, right? Any type of consumption for that matter, whether it's e-commerce or brick and mortar retail. Any product which you're consuming, anything you look at in this room, at some point of time passed through a warehouse, right? So any kind of consumption demand ultimately is going to end up in more warehousing demand. On the other hand, we are also seeing more and more demand coming from manufacturing, where certainly the large MNC guys who are setting up shop in the country, and we're seeing more and more of that with some of the recent initiatives that the government is taking in terms of let's say Atmanirbhar Bharat or Make in India or PLI or some of these buzzwords which we have kept hearing over the last several years. I think this time around it's actually translating to real action happening on the ground, right? So we are seeing that demand. And it's not just the MNC guys, right? The MNC guys obviously don't want to, come in and deal with buying land, getting approvals, and building the facility, and doing all of that. They just want plug and play, right? But surprisingly, also a lot of the Indian companies are also looking at life a little differently. traditionally the model for them was to, buy the land, own the asset on their books, but now they're kind of saying that, okay, listen, I want to be more capital efficient, right? So I don't necessarily want to own the asset on my balance sheet. I will, prefer to lease the asset instead. So we're just, accumulation of demand from all of these places, coupled with sort of the overall headroom for growth when we compare with some of our regional or global peers, means that, the demand is a no-brainer, right? So year on year, we are now definitely seeing 40 to 50 million square feet plus of warehousing absorption every year. This year was 46 million square feet, and most reports you pick up will tell you that that's going to grow by 18 to 20% CAGR for the next several years, right? So the demand is kind of a no-brainer. It's out there. The headroom is very, very large. And then specifically when you look at warehousing as an asset class, the other reason this looks very compelling is the fact that, what I mentioned earlier, that, these assets and this business model just looks very, very de-risked, right? And that is fundamentally because of the fact that warehouses are relatively uncomplicated structures, which are easy and quick to build, right? So once you've bought the land, gotten the approvals to build a warehouse building, since it's basically what you call a pre-engineered building, doesn't really take you more than 8 to 10 months, okay? So because of the lower build complexity, because of the lower cycle time to build these things, the largest risk when you talk about any development project, right, which is cost or time overrun, by default, that risk is fairly mitigated when you look at warehousing, right, just because of the nature of the asset. The other thing is that most of the business which we do is what you would call build to suit. And what that means is that, once we've bought the land, we don't actually start building the warehouse till we have a back-to-back lease commitment with the tenant, and the tenant has paid a deposit. Okay? So what that means is that, I'm only investing money in construction once I have a back-to-back lease commitment from a tenant. So at that point of time, I'm already fully de-risked from a market or leasing standpoint, right? So, just putting the demand side of the equation together, along with the fact that, the risk is very, very low, we think makes this very, very good.
Right. So the industry is really growing fast on a small base, and there's definitely a lot of headroom for growth. Great. One more thing which I'd like to touch upon is in terms of the context of inflation or inflationary environment in the country or more so outside, how do the real estate strategies or real estate assets stack up in terms of returns? Maybe Balaji, if you'd like to take residential, Amar, you'd like to take commercial, and Yash, warehousing.
Real estate assets have always been considered as a hedge against inflation. They'll always be taking care of inflation. In fact, one of the points that Yash mentioned, people used to earlier invest in real estate. Even if you look at the foreign banks, they had huge buildings. They had earlier invested in real estate because it was a hedge against their own inflation and rupee currency depreciation. And it worked well for them, actually. Some of those asset sales helped them later on to be able to hedge it. So I don't think real assets will ever disappear as a hedge against inflation. So even the commercial real estate, what you was talking about REITs, or you talk about warehousing, the rentals will always keep pace with inflation. So to that extent, you're well covered. And it's not that even if inflation does rear its head a little bit higher, you will go down, because it will get adjusted in the very next sort of a renewal. And we are seeing that already. If you look at your residential rentals today, it has gone up over the last 6 months. So I think that to that extent, it is a pretty much safe investment, because you're not going to lose because of inflation, at least.
Right. Amar, on the commercial side, impact of inflation, how do you?
So on the commercial side, it's direct. I mean, the increase in rentals in the commercial office side, whether you take 15% every 3 years or 4-5% every year, that is anyway baked into the agreements, and that obviously is there. But apart from that also, if you look at all the REITs, the 3 listed REITs, as well as even the unlisted large commercial spaces, there is enough potential for mark to market also that exists, where the current rentals of these office buildings is at which they are leased is to some extent lower than what it is for the surrounding location, and therefore that upside also is there. So that is of course there, but that's about 4 to 5% per annum. But what I was referring to on real assets, which is say for example toll roads, there the link to inflation is absolutely direct. And if you look at the recent concession agreements that NHAI for example has been bidding out these new packets, they are called TOT 7, 8, 9, 10, 11 and 12 are currently under bidding. There NHAI has clearly put a straight formula for inflation, which is 40% of WPI plus 3%. That is the increase in toll year on year that takes place without any questions asked by anybody. So that is in the agreement itself, and the beauty now is that more than 96, 97%, perhaps 98% of all the vehicular traffic on the national highways is electronically tolled through FASTag. And that is why collections also automatically done as soon as cars pass or the buses or trucks pass by the highways. So therefore, and it's a very diversified set of users. So that helps a lot in roads and infrastructure investments, which I was talking about, that there's a clear inflation pass through. In fact, on the positive end. So for example, last year we saw WPI at 14-15% for 4-5 months in the year. It was pretty sticky and it remains sticky even now. So at 15% WPI, 15 into 4, that's the formula, 40%. So that's 6 plus 3. 3% also is given. So 9% was the increase in tolls that was given to all the developers by NHAI as per the agreement, and it's a 20-year agreement. So that is the kind of increase which NHAI has been giving for the road sector, and to a smaller extent for the other sectors of infrastructure, but largely it's for roads. So real assets benefit hugely with inflation. They are the beneficiaries and not the victims, which most of the businesses are. Real assets also is a hedge. Real estate like residential and commercial is a hedge definitely.
We'd like to open the session for questions. If request the participants to introduce themselves and go for the question.
Thank you so much, gentlemen. Any questions, ladies and gentlemen? Oh, we have a questioner there. Sir, please. Can you raise a hand? We need to pass on the mic. Thank you. Gentlemen, it was a wonderful session. It threw literally a light on whatever aspects we're talking about, the funds and everything. Thank you.
Hi, my name is Sivanand. I want to understand in the current budget, there was a tweak with respect to tax for InvIT and REITs, right? So do you think there will be any impact on the structure of how InvITs or REITs acquire assets because of that, or if there will be any post-tax implications from investors' perspective?
Definitely there would be a change, because the way it was earlier structured was not just put it as equity but also as debt, so that you had a tax shelter. Today, because that has got plugged, so there will be some sort of a change. But will it lose its attractiveness? I don't think so. Will it become a little bit more taxable? Yes, it might be, but I don't think it will impact returns in a very major way. I think the structuring will become more straightforward, and I think life will go on as usual. So it won't be as a deal breaker, what we would call. Definitely not.
And just to add to what Balaji has said, if you look at what's happened after that, last 2-3 days, the prices have adjusted. So if you look at the prices of REITs, they've all adjusted to account for exactly this tax being in play.
Outgoing, yeah.
And therefore, on a post-tax basis, it is where it was pre-budget. So therefore, the prices have come off. And in spite of that, the prices are still holding up before, even now compared to what they were at the IPO. So they are still in positive territory, in spite of all the distributions.
Thank you so much, speakers, for making it an interactive session, and to my lovely audience as well. Now, let's move on to the felicitation part, which is the best one. Over here, may I please call on stage Aditya Gargeji. Please put your hands together, founder and CEO of Equalify. Everyone, Zordar Taliyan. Thank you so much, sir. Small token of appreciations with a lovely picture. Thank you so much, speakers. That was a wonderful and a powerhouse session.